Okay, it's time to start evaluating companies more closely as far as what we might want to invest in. And we're going to start with qualitative factors, basically things that might be more subjective. We're going to look at things like looking at a company's vision or mission statements and strategy. What is their strategy? And trying to interpreting their strategy and looking at things like strengths and weaknesses of the company and their external threats and opportunities. Strengths and weaknesses are internal to the company. Threats and opportunities are things that are external to the company. And we're going to do some things like a SWOT analysis around that. Plus, we've got other tools to look at the competitive landscape and looking at the competitive advantages and disadvantages and how to evaluate companies that way. So this is all going to be a section all around qualitative. Later, we're going to look at quantitative evaluation, things like the actual numbers, the hard code numbers. And some things we'll look at are some fundamental quantitative numbers, ratios like PE ratios, PEG ratios, dividend yields, different types of ratios you might be familiar with. But also then next, we're going to, and the next section after that is a big section around technical analysis or charting. What is the charts telling us to do as far as investing as well? So let's get started in this section around qualitative factors. When you're looking at different companies that you might be trying to decide around your watch list, what are the small group companies that you might want to really follow? One always good thing to do is if you're familiar with a certain industry or you worked in a certain industry, you'll have some kind of almost insider knowledge, you'll have that experience. So if I was a medical doctor, for example, I'm not, but if I was, I would understand maybe the hospital industry and sector better than, let's say, if I, learned, grew up through retail or that was where I did my business or something like that. So, and also you can use it as far as something that you have experience with. That's why a lot of consumer goods companies are companies where we use those products, whether it's maybe using Google or Facebook or Netflix, some of the high-tech stocks or Apple products. I have an Apple phone. Doesn't mean I'm expert in all Apple technology or anything like that, but I have some familiarity with their products and some of the things that they're trying to do, for example. So that's a good starting point. Another thing to look at is things like around companies' published mission and vision and strategy and their tactics. And we'll talk a little bit and give you some examples about the truth and what really is going on here. So stick around to the end. There's some interesting little quotes I think you'll find from companies. So when you think about when a company will talk about their vision and mission, and they can vary a little bit, but typically like a mission statement is what drives the company. And it's usually like around culture, a lot of cultural stuff. And you'll get into things like what do we do, whom do we serve, and how do we serve them? Talking about, their customers basically. Vision is more aspirational, right? It's let our hopes and dreams, what big problems are we solving for the greater good, and who and what are we inspiring to change, right? And so let's face it, some companies with their vision and their mission are more inspiring than others. I had a chance to visit with Medtronic. They make electronic stents and different things for medical devices. And all over their walls and all over the place, they talk about, and they actually have pictures of patients or people whose lives they've saved by using their devices. So, that's very, inspiring versus maybe, a Wall Street brokerage firm. But, that doesn't mean one's a better stock than another. It just seems something's more inspiring that way. And then if we think about strategy and tactics, strategy is about kind of like that, what is the big thing we want to do? And tactics is how we're going to do it. What are the specific steps we're going to do? So for example, like a retail store chain, maybe a clothing retailer sells it, offline and brick and mortar clothing retailer, maybe their strategy is they want to grow their market share, right? They want to have a bigger piece of the pie. And the tactics might be, well, we're going to open 15 more new locations. And maybe we're going to buy the number 4 competitor and merge them with us. And now we'll be bigger. And thus we'll be able to grow our market share. So strategy is a little bit bigger, the what, and tactics is more the how. So start looking at those different things. And some larger companies have separate divisions. Think of like Amazon, for example. You have Amazon e-commerce where we buy things online, but they're also really big and strong with Amazon Web Services, or AWS, which is providing web services like website the hosting and that kind of stuff. So with that, you want to evaluate their strategy and tactics maybe within each business unit too. And then it all rolls up into, let's say, one stock price. Now, sometimes all this stuff sounds great, doesn't it? It sounds so nice and wonderful, especially vision and mission stuff. But let's face it, some companies, and they're led by human beings, people, and sometimes they don't necessarily, follow their vision or their mission, and sometimes you actually get to see the real truth. The truth is what they actually do, not necessarily what they say, though sometimes it's what they say too if they're very honest. Let me give you a couple examples. So here's Chevron. The CEO of Chevron, this is a headline, said Chevron would rather pay dividends than invest in wind and solar. Chevron, of course, is a big energy oil type company, right? And the quote from their CEO, Mike Wirth, he said, "We'd rather dividend it back to shareholders and let them plant trees." What he means is we'd rather pay people like you and I who are investing in Chevron in the form of a dividend. We're going to learn all about dividends on it, but we're going to give you this dividend. We're going to give you the money, and then you and I can decide whether we want to plant a tree. But Chevron's saying, hey, we're not interested in, at least at this time, well, we're not even going to play the wind and solar game. We know what we are. We're an energy company. We're going to drill for some oil. So there's a bout of honesty if you ever had one. Another good example, I think, is Goldman Sachs, right? They're a big investment company, investment house, and their purpose, I pulled this from their website, their purpose is, at Goldman Sachs, we advance sustainable economic growth and financial opportunity. And our purpose comes to life through our 4 core values: client service, excellence, integrity, oh my goodness, integrity, and partnership. Now, Goldman Sachs have all sorts of integrity issues. And one of the quotes that many people from Goldman Sachs have said, behind the scenes, even public, have said, look, what does Goldman Sachs do? We take a big pile of money and make it into a bigger pile of money. That's what we do for ourselves and for our clients. That's maybe more the honesty. And then Facebook, of course, Facebook always got some scandal going on, right? Facebook's mission is to give people the power to share and make the world more open and connected. And you see back in 2017, they were going to give the people the power to build community and bring the world closer together. Their motto is actually to move fast and break things, is a long-time held motto with them. But of course, what do we know about Facebook? Privacy issues. Instagram causes teenage girls to have, body issues, and all sorts of stuff that they knew about. All sorts of scandals keep coming out of Facebook. Depending on when you're watching this video, I bet there's probably some kind of controversy with Facebook. So you can see they might have this great bringing people together mission and vision, mission, let's bring them all together and have a connected world. But then they do things that might be not so good, right? And that can impact the stock price. If things are going good and they're doing all this wonderful stuff, then and the earnings are there, then that's great. Then that'll raise the stock price. But when Facebook should always take a step back in stock when some new controversy comes to light. Now, as investors, we can trade around that. Maybe when there is a controversy and the stock goes down, that's a dip, and we might use things like technical analysis coming up in the course to see when there might be a buying opportunity when it gets more into timing. If you're a buy and hold investor where you're not worried as much about timing, you still might use timing to get in, but then you're like, okay, I know Facebook makes a lot of money. I'm just going to ride out all the bad times. And then also for many investors, they're like, look, I only want to invest in companies that are good for the environment or sustainable or have good governance or social from an ESG, a social aspect, are good for the community, truly good for the community. And so they might eliminate stocks just based on that. They don't want to invest in tobacco companies or defense contractors. That's perfectly okay. You're the investor. You get to choose. I'm going to give you the tools so you can decide what you want to invest in and how you want to invest in it and when to invest it and all that good stuff. But you get to choose who you want to be on your watch list and who you want to invest in. Okay, so that's this overarching mission, vision, values, and all that stuff. But do watch what actually happens versus what companies say. There's sometimes a big disconnect between what companies say, which gets to be a little bit more about marketing and public relations, versus what do they actually do. And as an investor, you want to understand that. Now we're going to look at some really simple tools that we can use to help you evaluate companies real quickly to see what might be to help you narrow your list down of companies that you want to follow and that are of interest to you. An easy to use tool, but a very powerful one, is what's called a SWOT analysis. So you go to business school. I went to business school. I have an MBA. And one of the first things you'll learn is a SWOT analysis because it's actually simple but very powerful. So let's learn about this. So when you look at companies, you can do a SWOT analysis on them very, very quickly. So SWOT basically stands for strengths, weaknesses, opportunities, and threats. And you're looking at a company from their strengths, weaknesses, the opportunities they may have, and the threats that might be coming at them. And you kind of organize that into a matrix. So let's take a look at that. So your matrix would look like this. So in one quadrant, in the upper left, you'd have strengths, right? And then to the right of that, you'd have weaknesses. And you can see going horizontally where it says internal there, these are things that are internal to the company. They control this, their strengths and their weaknesses. Below, the opportunities and threats are external to the company, as in these are forces that are out there. Either they're an opportunity like something we want to take advantage of as a company, or a threat where it's something that might impact us in a negative way as a company. So that's horizontally. And then if you look at the bottom, there's opportunities, which is looking at opportunities in the market, and threats that might be coming on you, as we discussed. But if you look at from the top there, going vertical, where it says helpful and harmful, so it kind of lines itself where things are helpful or when your strengths match up to your opportunities. See, going vertically there, that's when things are really good. Things that might be harmful are when you're emphasizing your weaknesses more, or your weaknesses kind of run right into threats. Maybe you're weak in a particular area and your competitor is strong in that area, an external threat being a competitor, and so that can become a harmful type thing or something to be aware of. So when you're looking at a company, look at this matrix and we'll be writing into this matrix. I'm going to do a demonstration for you with a company you're familiar with in a moment, but you'll fill in this kind of matrix. It'll be blank and you'll fill in this matrix so you can kind of start evaluating a company from its strengths, weaknesses, opportunities, and threats. So let's use an example. Let's use our friends at Facebook, only because a lot of people use Facebook. I'm not necessarily recommending or not recommending them as a stock to buy, but it's a good example of strengths, weaknesses, opportunities, and threats, also since a lot of people are familiar with them. So let's start by looking at their strengths. And this in the quadrants, you'd want to list as many as you can. You might have 5 or 10 strengths, but let's just do a couple for learning purposes. So if we look at Facebook's strengths, certainly they have social reach, as in their platforms. You may know that Facebook also owns Instagram and WhatsApp. And so that is some real powerful reach. They have millions and millions of hundreds of millions of customers. I think it's hundreds of millions of customers out there. And so when they have that strong social network, it's harder for people to leave that network, right? Their friends are on that network, their family's on that network, they're on Facebook, they're on Instagram, whatever. So even if they wanted to leave to, let's say, Twitter or Snapchat or something else, it's harder to do because they have, that connection there. And that's where Facebook has built that social reach. And that generates one of their second biggest strengths, which is cash. They have a lot of cash on hand, an amazing amount of cash. They're also terrific at producing more cash. Now we're going to talk about weaknesses and threats. Those are some drains on their cash. But basically, they have a lot of cash on hand, and that allows them as a strength to invest in other things. So when Instagram was first starting to become, starting to get popular or noticed, Facebook bought them and really overpaid for them just to kind of head them off of the path, so to speak, and have them become part of the family as opposed to becoming a big competitor. Thus, that's why Facebook owns Instagram and WhatsApp. So now let's look at weaknesses, right? These would be internal to the company, things that are more about the company and their control. And certainly one thing, we'll just have one here, which is controversy. Facebook tends to just generate lots of controversy, which impacts their stock price, impacts the way investors look at them. In fact, impacts them as far as being good corporate citizens. And we know about privacy issues and things that keep coming on around Instagram, or even when they first had their first IPO, there was all sorts of shenanigans around that, which really held up their IPO price for years, as far as not, getting as much gain on the stock price that held them back. So that's certainly a weakness and something if you invest in Facebook to be aware of, right? If we look at opportunities, certainly mergers and acquisitions, they have the cash, they have the financial wherewithal to buy companies, to invest in certain new technologies and new research, all sorts of stuff that they can do in as far as that cash. But one is mergers and acquisitions. The other thing from opportunity is they can be innovative, but they can also just strictly copy other people. If TikTok with short form videos becoming a deal, hey, let's just do Instagram Reels. We'll roll that out. So we can copy they can copy others. And use the cash to kind of overcome, maybe innovation from other companies. And then threat-wise, well, I think if you were to guess at that one, you would say, well, certainly government regulation, right? There's certainly a lot of regulatory looking right now at the big tech companies, Alphabet, which owns Google, Apple, all the big ones, as far as that, Amazon. But certainly Facebook is really in the crosshairs. Again, see how it ties back to their weakness of generating controversy and generating issues, and that just gets the government spotlight on you even more. So you're taking that weakness and magnifying it because you've taken that external threat that's always been there as far as for the company being more regulated, possibly even antitrust issues where they would break up Facebook into 3 separate companies, for example, has been discussed. Facebook, Instagram, and WhatsApp, 3 different companies as opposed to 1 company. So, that's something that Facebook as an organization would certainly be aware of and be very concerned about possibly. So that's a threat that's out there. And one thing that's a threat, in general, threats tend to go around competition. What is your competitors doing? Because they're always an external threat. And then things like government regulation too. Depending on what you do. Some industries are heavily regulated, like pharmaceutical companies, right, that make drugs or COVID vaccines or whatever. There's a lot of regulation around those versus, let's say, other companies. So that can be a threat for the company as far as, is there a lot of regulation or less regulation? So here's a simple matrix that you can use to do strengths, weaknesses, opportunities, and threats. The key thing to remember is that strengths and weaknesses are internal to the company, and opportunities and threats are things that are external to the company. And then use that to evaluate any stock real quickly that you're interested in. So if you want to pause the video right now, you've got a stock maybe you like, take a moment and just write out. I just use 2, for example, or 1 or 2 examples in each one, but write it out. Do 4 or 5 or 10 or whatever number. If a company's got many strengths or many opportunities, write them all down. And that way you can get a good picture of the company real quickly by using the SWOT analysis. A very, very helpful tool I use all the time. Another very helpful tool is the Porter's 5 Forces analysis. It's really looking at these forces or things that are external to the company that are impacting the company or potentially impacting the company that all companies need to be really, really aware of. And it's a great tool to use when we're evaluating the position of a company in its industry and as it's set up for success, particularly long-term success. So let's look at these 5 forces and see how we can use them to our own advantage when we're evaluating companies to invest in from a stock market perspective. So if we look at this graphically, we'll start in the middle with a competitive rivalry within an industry. How many competitors are there? Are they very strong competitors? Or is there a few competitors? Is there many competitors? How competitive is the industry overall? And where do we stand right now in terms of market share and stand within that competitive industry and in relation to our competitors? Next, we'll look at bargaining powers of suppliers. How strong are those people that supply our product to us as far as influencing us on the price that we may pay for their goods and services? So let's say, for example, that we make tires, right? We make tires and we sell tires to automobile manufacturers who put our tires on their cars. So one of our suppliers would be people who make rubber, right? Rubber for the tires. So if the rubber plantations and the people who make rubber decided they didn't want to sell to us, well, we couldn't make tires. So they have a lot of power. Now, if there's a lot of rubber suppliers, then they have less power than if there's only a few that really control the market. But either way, they have a lot of power because we need rubber to make our tires for sure. Next is the bargaining power of customers. Your end customer. How strong in terms of price and price demand is your customer? Can they, look at other products? Can they, cause your prices to go down or up? How much strength do your customers have in terms of bargaining power? So and do you have a lot of customers, like a business to consumer where you have a lot of customers, or you more business to business or B2B where you might have only a few customers? If we look at the tire example again, let's say I'm a tire manufacturer and I sell to GM and I sell to Tesla and I sell to Ford and that's it. If one of those decide they don't want to buy from me now, they have a lot of power, so they can negotiate, price concessions from me. I can't sell my tires as much because I'm so dependent on maybe 1 or 2 or maybe 3 big automakers versus having a lot of customers with less power. Another force to look at is the threat of new entrants, right? What is the chance that somebody new will come in, a brand new competitor will come in, and really take market share away from us? So that's looking specifically at the products we sell. Let's use the tires example. Be somebody else who makes tires, for example, would be a new competitor. The other thing that's similar to that but different is the threat of substitute products. What could be used instead of something else of the product I sell or the service that I provide? So if, like again, for tires, if all of a sudden cars weren't being made with tires, well, that would really impact my business, right? So there isn't much threat of substitute products from a tire standpoint. There might be threats of alternate modes of transportation. If all of a sudden we can, let's say, teleport somewhere, that might be pretty good for us, but pretty bad for people who sell tires on cars. But maybe a better example might be, let's say we made gas-powered engines, right? And now and we sold to automobile manufacturers. What's happening now? A lot of electronic vehicles or EV vehicles, right? So not using gas-powered engines as we go more in EV, and EV seems to be the wave of the future. So that's a substitute product. A consumer can say, instead of buying a gas car, I'm going to buy an electric car, and if I made gas-powered engines, I'm going to sell less. The manufacturers of those cars are going to sell less cars, and thus I'm going to sell less gas-powered engines to them. So you can see these are 5 forces that you can evaluate a company with, in terms of seeing, their strength and how they, basically operate in this external environment. Let's use one company as an example to walk it through in good detail here, and then you can, use it on your own as far as companies that might interest you. So let's say you're now the CEO of Coke. Congratulations on the promotion. So you probably hopefully got a bunch of stock options and stuff, and a nice salary, right? But now you are going to do, first thing you're going to do is you're going to do like a Porter's 5 forces analysis. And we're going to look at, and that's what we'll do right now. We're going to look at Coke and how does Coca-Cola, compete in their competitive and external environment. So basically you can use this blank form here and you just write it out or fill in the blanks, but let's do this for Coke. So if we start in the middle with competitive rivalry, does Coke have a competitive rival? You bet, it's Pepsi, by far, right? There are other competitors out there, but it's all about Pepsi. In fact, I think one of the mission statements for one of the companies, I think it was Coke, was beat Pepsi. That was their mission statement, or maybe it was Pepsi, and their mission statement was beat Coke. So everything they did was, how do we beat Coke? That's how strong the rivalry is with Coke. So if we were looking at Coke, we'd say, do they have competitive rivalry? Yes, very high, very much so. And who is it? It's Pepsi. If we go down to, or if we go to the left here, bargaining power of buyers, I would say that's medium. That's you and I buying their products, Coke, Diet Coke, other types of Coca-Cola products. And I'd say medium only because there's some brand loyalty there. There's a lot of folks that like Coke and would not drink Pepsi and vice versa. So there's that brand loyalty there. Though it is very easy to switch. I could switch away from Coke to Pepsi the next time I go to the grocery store, next time I go to the market, right? So you could say that's actually a high bargaining power of buyers, and I would give that to you. But I think because of the brand loyalty, we might say that's medium, even though it's very easy to switch. If we look at threat of new entrants, these are companies that compete within the exact same space. That's low. It's really that, carbonated beverage, flavored beverage, cola type beverage is really dominated by Coca-Cola and Pepsi as far as a pure competitive play. We'll look at substitute products in a moment, but a pure competitive play. There are competitors out there, like one in the United States is called Jones Soda. Maybe they're in other parts of the world too, that make a more unusual flavored type of sodas, or where I come from, we call it pop, but sodas, carbonated beverages. But still, it's really all about Coke and Pepsi. And thus, they have such a strong market share and such strong marketing budgets and things that it's hard for a new entrant to come in. They have to be really unique, like Jones Soda is unique. So it's low in terms of the Coke and Pepsi. They just have to worry about each other more so. Then when we look at the bargaining power of suppliers, I would say that's low. For many of these companies that do bottling, or they do the, things that help with the flavoring, or even the marketing companies that provide marketing, they don't have a lot of power because Coke is so big and so dominant. They might be certainly their biggest customer, might be their only customer. So if Coca-Cola says, well, we need, more cans faster from the aluminum maker, or the can maker, they got to then go to the aluminum maker, say, we need aluminum because we got to make cans, because Coke needs more cans because they're going to have a big sale over the holidays. So Coke can exert that pressure versus suppliers saying, nah, we're not going to do that. In fact, we're going to raise our prices for our aluminum cans too. Coke would say, great, there's a million other places that want to sell us cans because we're going to go through millions and millions of cans every year. So I would say, personally, I would say that's low. You can disagree with that. I'd say it's low as far as bargaining power of suppliers. And then lastly, if we look at the threat of substitute products, not the exact same competitive product, like a Jones Soda might be more considered that, but something that's similar but different enough to be a substitute. Something I'm going to do instead of having a Coke, I might drink this instead. And I say that's high. There are a lot of different substitutes you can have. One in particular growing area is water. Certainly water is better for you than either Coke or Pepsi. And also water, you can get flavored water, you can get different types of water. There's also different things like sports drinks out there like Gatorade or Powerade. And in addition, you could have substitutes like alcoholic-based products from wine or beer to, to seltzers or whatever it might be. All these things are potential things that could, instead of me buying a Coke, I could be grabbing for, a bottled water or Perrier or something different. So that's actually high as far as the threat of substitutes. So when you look at this, you can look at all, from a holistic standpoint and see, well, what are these 5 forces and how is this affecting the competitive landscape? And if you combine it with like SWOT, strength, weakness, opportunity, and threats, you can kind of look at this and see how SWOT matches up too. And you can look at things like threats, like government regulation or different things around, maybe, regulating, not Diet Coke, but regular Coke because of some of their high calorie properties, and would there be extra taxes or things around that that have been discussed, even used in some parts of the world too, and that would be part of their external environment too. So when you look at things together, like if you look at the SWOT, you look at part of 5 forces, we're going to look at more stock specific, like around moat and competitive analysis and seeing how, real deeper at competitors. You can really get a good feel for this qualitative aspect of looking at companies from this qualitative standpoint before we start looking at companies from fundamentals, which is their stock and price ratios, and technical analysis, we're looking at their charts, and so we're making more buying and sell decisions on their stock. But this is qualitative stuff, looking at their overall positioning within their industry and positioning of their business, and whether it should have a position in your stock portfolio. In this section, we're going to talk about the moat, and the moat is really like a castle has a moat around it to protect the castle. This is like with businesses where they have competitive advantages. That's kind of what protects them as a company. Maybe they're really great at having lower costs and they can really be real price competitive. Or maybe they have a strong brand name, like Apple has a great strong brand name, and that provides them a moat or some protection in the competitive environment. So we're going to look at these different types of moats companies can have in this section. So when you're evaluating companies, you can kind of evaluate them and say, wow, how strong are they in the competitive landscape? What's their moat look like in this section? So the first one is looking at a company, when we're evaluating a company, to say, well, who are they? And there's really 2 big areas to look at in terms of how they serve their customers in terms of a price and value, right? So if we think about price, you have what are called low-cost providers, where their focus is on price is everything. And so if price is everything, that we want to provide the lowest cost, and how we win in the marketplace is we're just lower price than everybody and have that strong reputation for a low price, then everything you do is going to be around that. And a big part of that is around things like controlling costs. How can you reduce your human capital or your labor costs? How can we be more efficient in our distribution, moving services and goods around throughout the organization and getting it to the customer? How can we drive costs out of the organization so we can bring the prices down for what our customer pay? A lot of times that's also negotiating with like the vendors or people might supply things that you might resell as a customer, whether you're getting raw materials in for a manufacturer that you're then going to put together and then have a final product, or even somebody like a retailer who's going to then resell something and that they're getting something maybe direct from a manufacturer or from a wholesaler. How can they negotiate prices with those companies to push their price down so then they can offer at low prices to the final end customer, whoever their customer, which could be a consumer or it could be another business, either business to business or B2C, business to consumer. So that's one strategy if we look at these strategies, is being that low cost provider. You might already have some companies in mind that you might say, yeah, they're the cheap guys in town, they're the low cost provider. Another way, the opposite end of that spectrum, is not to be the low cost provider, actually to charge a high price, but you're going to be differentiated. It's called differentiation. And you're adding more value. People buy from you because you add great value. And that's the difference between you and a low-cost provider. Like, you kind of get what you pay for with a low-cost provider. You might have heard of that term, right? Where a differentiated company, we'll look at some examples here, is all about customer service, value, high-end, great products. People love their brands, and they're not worried about price as much, and they don't shop on price when they're buying from these companies that are differentiated. And ideally, from a management standpoint, if this was a management class I was teaching, I've taught management classes, is you ideally don't want to be stuck in the middle. It doesn't mean you can't succeed if you're stuck in the middle between being either low cost and low cost, or a little higher price, or maybe a high price and adding a lot of value. You don't want to be stuck in the middle where you're higher priced than the low cost provider, but you're not offering enough value to make people want to pay that higher price no matter where it is on that spectrum. So ideally, you want to be one or the other, typically for companies. And companies, when you're evaluating a company and you say, yeah, they are definitely a low-cost provider, or in their market, they're definitely differentiated, and they really have that strong brand name. Those are things that tend to, be companies that, even if their stock price temporarily goes down, they've built that moat around their pricing and how they interact with customers to rebound past that. So if we look at a couple examples around that, now I have people from all over the world who take my courses, over 250 countries. It's just crazy, which is great. I'm so thankful for that. But if we look at, like, in the United States and other places, there's this company called Walmart. If you're from where I live, you know Walmart. And they're always have been about low price. And they're very ruthless, actually, working with their suppliers and all that, and to try to drive price out. But when you go shop at Walmart, you're hoping for a large selection, but you are going there because you know you're going to get low prices. That's the whole idea of that retailer. And they sell everything from groceries to soft goods like clothing to hard goods like sporting goods, for example. They sell everything. And they are the low-cost provider in everything they sell as a retailer. If we look at another retailer, Tiffany & Company, well, Tiffany is a higher-end or high-end manufacturer, or not manufacturer, retailer of jewelry. You might have seen these fancy blue Tiffany boxes, or if you're fortunate enough to have received one as a gift, that's very nice, because inside is something very nice. And so if you go to one of their places, you're going to get great service. People are going to help you. They're going to pick out the perfect diamond for you or for your loved one, and you're going to get that high quality service and made to feel special. Like you won't feel special at Walmart, but you'll feel special at Tiffany. But you pay a lot for that. And you do pay for that as far as the jewelry and the brand around that. So both these companies are strong from a moat standpoint and in terms of being a low-cost provider or a high-end differentiator. Another thing that companies can kind of hang their hat on, and they can be playing in a lot of these multiple areas, is high switching costs. And what we mean for high switching costs is that it's painful or expensive for a customer to switch to a competitor, right? So if I sold paper, just paper you put in a printer, and the person in the store next to me sold the same paper, there's no differentiation, there's maybe just pricing, there's no high switching costs. I can go buy my paper from anybody, for example, in that example. But if it's something that's expensive or painful for the customer to do, they're more likely not going to do that. So that's a high switching cost. As me as the consumer, or it could be a business who is the consumer, they say, gosh, maybe I want to make a change, but it's just so agonizing to make the change, or it's expensive to make a change for me. I'm just going to stick with who I have. And that's a great way of some business success for the people who have these high switching costs for their end customers, whoever that might be, a consumer or a business. So if we look at an example of that, let's think about your email. Is there a particular email you use or like, whether maybe it's something like Microsoft Outlook or Gmail? Now think about, okay, now in the next hour, we're going to switch all your email over. You're going to have to learn a completely brand new email, never used it before, maybe something completely different. Now, if you think about that from a switching cost, you might be like, I've used Outlook for 15 years. I don't want to switch to Gmail, or I don't want to switch to some other weird type of email thing I've never even heard of. So those are high switching costs. And in fact, those are not necessarily expensive to switch from, but they are certainly expensive in terms of being painful for somebody to switch their email. If you've ever had to switch that or learn some new software, you know that that's in the same thing with project management, whatever, that there's certainly that learning curve. And so that's where software companies try to get that market share, and because they know it's harder for people to switch once they've been using their product for a period of time. Along those lines, too, is the network effect, which is, it means it's more about looking at the competitors because you built this great network. So it's expensive for a competitor to build out a competing network or infrastructure. So what do we mean by that? In network infrastructure, think of things like a distribution center where you move product from the distribution from, let's say, manufacturer, goes to your big warehouse distribution center, and then moves on to an end customer, and you built those all out over an entire country or over the entire world, for example, to replicate that, the cost to replicate that and try to catch up for a new competitor is very difficult. And so they might not want to compete in that area, which gives you a little bit more exclusivity. It's part of your moat or things that protect your business. And so when we're looking at investing, we can say, well, companies that have these strong, networks of distribution can be very, very powerful. That's why utilities, for example, most utilities can vary around the world, but at least almost everywhere, utilities are managed by the government or managed in a certain way because it's so difficult to also make a whole brand new electric grid. So if you and I said, let's go into business and create the electric grid over, over all of Latin America, that would be pretty expensive to do and hard to do. So we might want to take our business ideas somewhere. So that's one of the challenges a lot of technology companies face. Some have these great networks, but some it's easy to replicate because it's more digital driven. So it does vary, of course, but that's the idea of a network effect. So if we think of like a company like Amazon, for example, and their distribution centers that they have all over the world and continue to build them like crazy. I have a big distribution center near where I live, and so I can get merchandise shipped to me the same day in many cases. In fact, they're building a second one nearby for large goods, like if you want to order a sofa or a refrigerator, I think. It's like 30 minutes away from my house. And so I can get these things very quickly. Now, try to replicate that and all the equipment and people and training and land and building buildings to replicate Amazon's network at this point. It doesn't mean it can't be done, it just means it'd be very difficult to do. Here's a quick snapshot of just the United States where you can see where they've got some open warehouses, others are planned. This changes like on a daily basis. So I really want you to just more get a feel for like, oh, if I want to go on the East Coast, look at all those distribution centers that are out there, and you look at where the major metropolitan areas are in the United States, they're pretty much there and continue to expand. So to try to replicate that and overcome that moat of theirs would be very challenging. Another moat area is strong brand names, right? They have this reputation for quality, and people have this strong emotions and attachments to the brand, the product or the brand. Think about some brands that you like right now as we're talking here, and think about, oh yeah, I really like this type of cell phone, or I like this type of television or a computer, or whatever it might be, clothing, whatever it might be. I really have that brand affiliation, and we all have some that we really like those brands. And the reason we like those brands is a big part of that is we enjoy using them, and there's a trust aspect of it too, that if I buy this brand, I know it's going to perform the way I expect it to perform, and I may really actually enjoy that. And by having that strong brand name, it prevents more competition from coming in to try to overcome that already established brand name, and they can charge higher prices and drive higher profit margins, help them be more successful financially, more successful for a stock investment for us. So let's say a brand has a hiccup or something happens and that company's stock goes down, but we could look and say, wow, but they got that strong brand name. We know if they turn things around a little bit and get a couple of things, maybe control a couple of costs, whatever it might be, that we know that brand is going to carry them because they have that real strong, loyal following. And they have that strong brand name because people know them, have used them for a long time, and really trust that brand name. So for example, let's take a look at this picture. I bet you can already guess who that strong brand is. There's no name of the brand on there. There might be a little picture of or a little indentation on the wall there of an apple. And I'm sure you guessed that, oh, these are people who are waiting in line to buy probably the latest iPhone or Apple product, which is, what a great example of a strong brand name. There's some things I would not wait in line 10 minutes for. Yet you have lots of people, these folks here, who might wait overnight to get the latest and greatest and pay a premium price. That's a key part. Pay a premium price for the latest and greatest product from them, like an iPhone or an Apple product. And it's all over the world where you see this, as far as this brand name that's been developed. Here's some holiday shoppers, and they could be, going anywhere, but they're going to go stand in line to buy that Apple product because of that strong Apple brand name. Somewhat akin to brand name, actually, is that reputation. They can kind of go hand in hand in a lot of ways. And that's a reputation for quality and a reputation that it does what you expect it to do. I think that's the key thing. So if you're buying, let's say, a pair of Levi's pants or jeans, a strong brand name in that area, you expect it to fit comfortably, or a certain way at least, and you expect it to last, at least for a certain amount of time. You have these expectations for that, where if you buy an off-brand, or a knockoff brand, you'd be like, I don't know what I'm getting. I might save some money, but I don't know what I'm getting. And that's where, so these strong brands have developed these strong reputations. And so you might look at a reputation of a company for quality and it does what you expect. And that's part of their moat too. And it's harder, again, for people to compete and overcome that because they have to overcome the reputation for their own product. Doesn't mean they can't do it, but they have to overcome that strong reputation of the other company. So we think about like a company that, or service that does what you expect it to do. Have you ever used this? Well, of course you have. You've probably used it today. If you haven't, you'll use it later today or tomorrow for sure, I bet. Well, how many days can you go away without doing a Google search? Now, if you work for Microsoft or you use Bing, which has a much smaller market share, great. It does the same thing. But one reason people love Google and Google search is it does what they expect them to do. And they have that reputation. In fact, when you search for something in Google, and it doesn't find exactly what you're looking for, which is actually kind of rare, but let's say it doesn't, you don't blame Google or Google's algorithms, you blame yourself, which I think is amazing. You blame yourself like, oh, I must have typed in my search term wrong, or maybe let me try another search term, because it can't be Google's fault. No, it's got to be my fault. How strong a brand name is that? And that strong reputation for it's going to do what you expect it to do, when you'll blame yourself before you actually blame the company. I mean, so that shows that trying to develop search, which Bing is number 2, is a good search engine, but trying to overcome that lead that Google has built over time is just very difficult for Microsoft, and not impossible. And they've chipped away, and they have a really good market share. But it's not the only service they offer, and nor should they, because they wouldn't be as successful as they are. Versus, let's say, if you were using some Microsoft products that you might like Excel or something, and it does what you expect it to do. Similar to the network effect is these economies of scale in terms of really building a business. And when we're evaluating business, do they have these big economies of scale? And you think about economies of scale, think about somebody trying to go in there having large upfront costs to even get started. It's just going to cost a gazillion dollars to get started and do something. Some things have very low economies of scale or low upfront costs. If you want to start your own web page, for example, it's not too expensive, certainly less than $1,000, especially if you do it yourself. You can, the programmers and the thing, say, oh, it's free or whatever. There's lots of ways you can do it, to develop your own web page. But if you look at some of these big companies and the things they do, they have that big economies of scale. And so as they build these organizations, they have these great cost savings and higher production levels that they experience as they keep getting bigger. That's the economies of scale of getting bigger. So the upfront costs are very expensive, but as you start learning and you start organizing things, you start using things like lean manufacturing or Six Sigma, whatever it might be, ways of quality control, that you can have these cost savings and these higher production levels, which makes it you a much stronger competitor, because competitors can't come in because of the high upfront costs, so they're wary of that. And then you've already established your greater cost savings and higher production levels before they've even maybe gotten in. If we think about somebody like that, think of like Tesla. That's why Tesla stock will tend to do well, because in their space, electric vehicles, they've built these, and actually in batteries too is a big thing, a big area for, we think of vehicles, but it really is batteries that Tesla's massive in. And we think of things like their gigafactories and all that. I mean, look at that. How much do you think it would cost to build one of those guys? Well, you could Google it, you can search for it and probably find out or get an estimate of the cost or look at their annual report. But if I'm going to do and compete against Tesla, I better have a lot of money to kind of replicate these factories and replicate these high upfront costs. Doesn't mean they don't, like traditional car companies like BMW or Ford or GM, they've got money that could maybe replicate it. Or some smart startups, maybe some startups that maybe look at a particular market niche, like Lordstown Motors is an electric vehicle maker that's specializing in commercial trucks. Now they may expand from that, but they're looking at pickup trucks, electric, looking to that commercial customer, like a contractor, for example. And that makes their stock actually very interesting from a growth standpoint. But to try to replicate what Tesla has done and invested all these years is very, very difficult. So, others like Amazon, others are the same deal, where they've invested a lot of money up front and given them a lot of strength. And one thing you may not think of, actually, is government protection. And now governments, especially in more democracies and all that, allow companies to compete. And the ideal is that we want to have an open and free marketplace. We don't want the government to put their finger on the scale or to influence it in any way. We want the government to make sure that the flow of goods and services is easy for consumers and businesses, and that's a fair level playing field. We don't want to have antitrust or monopolies where somebody controls everything. But there are areas where government gets involved and actually provides some protection or advantages to companies. So when you're evaluating a company, if you say, well, if there's some large federal or broad country-based protections or support, or even maybe even local if you're looking at some smaller companies, but certainly for those bigger companies where there's government, I guess I could say interference or influence would be maybe a better word. So it's less common today for it to have like total monopolies, where, and it's illegal in many places like in democracies or like the United States, where you're the only company and you offer the only service and you can price whatever you want. And that's kind of that term of a monopoly. You think about the rail barons way back when creating the railroad networks, and some of the steel monopolies and things way back when. So that's why we have laws against monopolies, to have more competition, to make it better for consumers like you and I, that we have more choices. And actually, if you see now, it's less monopoly, but more like a small groups of companies that really compete, like might be in 2 or 3 companies that compete in a space, or there's one dominant company. That's certainly an issue that's been talked about when we're filming this about technology, is how strong are companies like Amazon, Facebook, Google, Alphabet, how strong are they, even Apple? So, and I mean even Apple because they've got big competitors like Samsung. So, but companies can get support and favoritism from their government, which gives them a big advantage and is part of that moat that helps protect them. So if their stock goes down, you can see, well, we know that the country is not going to let them go out of business, or they're going to give them opportunities to help rebound and try to succeed. And that might be another thing to look at from a qualitative standpoint. And then we'll look at our quantitative numbers to see if it still makes a good investment sense, to say, oh, okay, if we have this safety net of a big country behind us, maybe that's going to help us here. So like, well, what are some examples of that? Well, let's look at one real key example here, and that's France with Airbus. You might have flown on some Airbus aircraft. They're actually very nice aircraft. I think some of them are very nice. And they're a big competitor, one of the really 2 big competitors in the aerospace, commercial aerospace, passenger type aerospace industry. They make planes for these airlines, right? Airbus, they'll compete against, of course, Boeing. But France, helps support and really supports Airbus as a company and does more than a normal country would do to help support them for sure. And this is where we're talking about, like, you don't really have monopolies anymore, but you have these small groups of companies. Like, this is what's called a duopoly or duopoly. Think duo for 2. And you see this a lot where there's really 2 main competitors. There might be some other outliers, but there's really 2 that dominate, let's say, the large commercial aircraft space. Small aircraft, you might have Lear and other types of people, but Bombardier, others. But here you have Airbus and Boeing. And so it's really, a tale of these 2 fighting it out every time for every big contract. So if Air China wants to buy 10 aircraft, it's these 2 who are fighting it out. And so this is where government can get some support here. Here's some examples from some articles. Well, here's the links for them too. But you just look at the headlines, here, France's aerospace industry, which is several companies, but really we're talking about Airbus here. It even says in the subtitle, Airbus and smaller companies, they don't even get a name, gets $17 billion in government support. Or there's an article here about U.S. and Boeing have had a long and a special relationship. Should countries have special relationships? Well, they do in this particular case. And Airbus looks to end trade dispute with U.S., in effect Boeing, by foregoing some government support. And this is where the United States as a country is saying, hey, it's not fair what you're doing with France. They're giving you some extra support. So we're going to put tariffs on you. Excuse me. We're going to put tariffs on you to make your products more expensive if you're selling to United States airlines, for example. So Airbus is trying to navigate through that. But the whole point of that whole part is that you're trying to work through these government supports, or these government supports can be very helpful. Well, there you have it, the moat. And if you read a lot about value investing, you might see this term come up a lot. Things like moat and margin of safety are terms that are used a lot in value investing. And the idea is that you want to buy good companies whose stock price is depressed for some reason, maybe some bad news or something's happened to depress their stock price. But you feel that because of some of these factors we're listing here under this moat, they have that built-in strength to rebound and be successful, maybe more successful than ever. And so looking at these areas, of these different areas of the moat, companies can be strong in one area, and they're really dominant in that one area. Maybe they're the real dominant low-cost provider, or they've really developed this economies of scale, or that government protection, like we talked about with Airbus. These are things that are dominant factors for them. And some companies enjoy more than one. So let's take a look at a company you would be aware of that I hope you'll recognize here in a second, and evaluate that company in terms of these different factors and see where they stack up, as far as that company will go, and what are their real strengths that they have. And they can have more than one, and this company will have more than one. So let's look at a company you might be using yourself all the time, which is Facebook. And certainly Facebook as a company has had some at different periods buying opportunities. They've had a lot of negative publicity or negative news around things like around elections, how big they become and how dominant, monopoly type stuff, certainly around data privacy issues around that. There is a lot of issues around Facebook for sure. And their stock price has reflected that, where they've generally been on a very strong upward trend for many years, but they've had opportunities or situations where their stock has really dropped in price, and there might have been a buying opportunity there. And when you're evaluating a company like that, you could look at it quantitatively, but then looking at it qualitatively, how strong is their moat in this example or in this lesson. So let's look at Facebook a little bit from a business standpoint to give you a feel for this. And I'm not endorsing Facebook one way or another. I'm looking at it strictly from a business standpoint, from an investor standpoint. I know for many people, Facebook, no big deal. And for others, it's like they're the devil. So I understand that, and that is perfectly okay. Let's look at it from a business standpoint, though, and whether somebody might want to invest in them. So if you think of Facebook, Facebook has really two customers. They've got you and I, regular people who are consumers, and then they have businesses that they sell advertising to, or advertising space, in effect, to on their platform. And that's how they get their money in. Because Facebook, for us consumers who use the product, is a low-cost provider, maybe an ultimate low-cost provider because it's free. Right? So if somebody wants to come in and start competing in social media, it's hard to compete against free. Besides the other things they have, economy of scale, whatever it might be, it's hard to compete against free. So that's kind of the name of the game in the social media space, as opposed to say, hey, I'm starting a new social media network, it's going to be great, you need to pay $20 a month for it. And it might be a great service. It better be very differentiated and very high value for somebody to pay something $20 a month, US, versus, let's say, or more, versus something that is versus that's free. Doesn't mean it can't happen. It just means that you need to have that value. So low-cost provider, they're definitely a low-cost provider. But for their business business, which is their selling of advertising space, you could almost think of them as being more differentiated. If you think of low-cost provider might be offering low value, but at a low cost. Facebook actually, the way their pricing structure is set up, some would argue is actually very expensive to advertise on Facebook in terms of just the total amount of money that you might spend or the total clicks or whatever you're looking at. But it's highly differentiated from that business to business, basically businesses buying advertising space because of its targeting. With Facebook, they've got all this data on you and I, one of the controversies, and they're able to take that data and then sell that to companies to really target their advertising. When you advertise, let's say on television, you're basically blasting out to a lot of people, and many of the people, if not most of the people, are not interested in your product at all. Where Facebook could go to a company and say, let's say a mutual fund company like Vanguard, and say, well, we know that people like Steve, and maybe people take his courses, based on their searches or the things they're doing on Facebook, places they're following, articles they're reading, whatever it might be, that they're interested in investing. So you as a mutual fund company want to advertise to investors, right? Hey, pay us a certain amount of money and we can put your ad just in front of people who have some interest, some more than others, but some interest in investing versus maybe, my wife who's more interested in accounting and maybe gardening or something like that. Certainly the weather, she loves the weather, versus somebody who might be very interested in investing. So Facebook is kind of a dual in that way, but certainly from their main product line, what most people think of Facebook, low-cost provider as far as what they charge, which essentially is free. And I think from a business standpoint, again, not endorsing them as a company, but certainly as a business standpoint, you could look at them and think about high switching costs, right? Think about people who are on social media or certain platforms. It's a lot to switch from that platform, especially if you built up a network of friends and family. It can be very difficult to switch. I remember, because that's what you're used to using, and you've got that network of social media network. I remember watching a very good documentary about Facebook and about some of the negative aspects of Facebook, and there's this professor talking, and she really outlined a really good argument against Facebook and some of the, she would say, bad things that they're doing, from election influence to data privacy to lots of things, things that you see in the news all the time. And at the end, after she laid this all out, and they had, had this longer documentary, but at the end they asked her, well, would you You're on Facebook. Would you leave Facebook? This professor laid out all this negative stuff, and she said, of course not. Unfortunately, all my friends and family are on Facebook, and that's the only way I can keep track of them and people I know and colleagues I know all over the world. So I would not leave Facebook. I just want them to reform. Think of how high those switching costs are that somebody really dislikes the company but can't leave the company because of those high switching costs. Network effect, yeah, they've got that broad network, and we look at on the other side, economies of scale, they've certainly built that, but it's a little bit easier to replicate in a digital world versus building physical plants. So I'm going to give them a strength on that if we make it a little bit stronger. Certainly strong brand name. Well, it's certainly got brand recognition. It might have some negative connotations to it now, but certainly it's a brand name. I bet there's very few people who are Googling right now, and there's another strong brand name, Google, who are looking right now like, what's this Facebook company Steve's talking about? I've never heard of it. Probably, there might be a few of you. If you do, that's great. We'll find an interesting company, good and bad. And if we look at reputation, you could even argue that's a negative actually for them. If they were to turn that around and become a strong, reputation to go with their strong brand name recognition, that'd make it a real powerful thing. But if anything, they've got an opportunity for competitors because their reputation has been really knocked around a lot for some of the controversies around there. And you could just Google Facebook controversies or internet search. Let me say it that way. Internet search, Facebook issues, controversies, legal challenges, whatever, you'll find everything you want to find. We talked about economies of scale. Yeah, a little hard to replicate. That's different than switching costs for the consumer. It's more the economies of scale of what Facebook's built for its business. And then in terms of government protection, actually Facebook is in a period where the governments are actually, many governments are actively going after them from an antitrust standpoint, from data privacy issues and election issues, and how they manage their platform, their social media platform. So I wouldn't say they're really got a lot of strong government protection like Airbus would have in France. I would say, if anything, they might have more of an adversarial or conflict relationship with governments. So if I was to look at Facebook in general as a company, I would say low-cost provider, but differentiated with their advertisers, really high switching costs, strong brand name, but they're really struggling with reputation and government protection. And it's usually in these areas of reputation and this government protection stuff where government might be, hauling their CEO, Mark Zuckerberg, in front of, let's say, Congress or whatever to interrogate him publicly, that those are opportunities that when you hear news on that, that's when, if you look back at Facebook stock, that's when their stock may drop, and sometimes it's dropped significantly, where it might be a buying opportunity as a value investor, and it's turned out to be, at least in the past, who knows what the future will hold, but in the past, it's been like, yes, they have these reputation issues, they have this government protection issues, they have these issues that governments are actively going after them. But let's face it, with their advertising model, Facebook is a money factory. It's like they're printing money. It's like a casino where they just, it just makes so much money so fast. And they've built all these things that make it hard for competitors. And you can even say from a reputation standpoint, one thing they do is they'll buy out competitors before many of them can become strong competitors against them. You may or may not know, for example, that Instagram and WhatsApp, which is used all over the world, particularly in places like India, are owned by Facebook. They were bought out by Facebook. Basically, Instagram was paid a huge premium for Instagram that had not really built much in terms of their social media network at that point, but Facebook saw the threat, and so they bought them out. So another reason, if their stock price goes down, somebody might want to invest in them. And then there's others that say, look, they're way overpriced. You look at their price to earnings and some of the ratios, it's like, yeah, no way. And it certainly might not want to invest in them from a social standpoint in terms of, what's good for the country, the world. You might have some issues with Facebook that way. So either way, the idea is to look at companies like we just looked at Facebook with dispassion. Remember, value investors are dispassionate. If you have a feeling and strong feelings that, okay, like you say, I will not invest in certain companies. I will not invest in companies that do, oil production like Exxon or marijuana companies, or I won't invest in defense companies that make weapons or guns. That's perfectly fine. Just eliminate that from the companies you're going to look at from a value investing standpoint. But when you get your universe, your small handful of stocks you're going to look at from a value investing standpoint, that's where you've got to be dispassionate and look at companies and say, is this a good opportunity for me as an investor to invest? And then hopefully that stock, because the stock's beaten down and we're hoping for that price to arise. In addition to quantitative factors, this is where looking at that moat or qualitative factors, very, very critical Very important.